This is the final module in this series on national income. So you're looking at the finale of national income in a closed economy. We look at loanable funds, fiscal policy tools to change national savings, and how technology affects investment demand. Now we look at two things. One is assumptions. So some of the assumptions which you've already seen, that it's a closed economy. We are just considering this as an example. So net exports is equal to 0. We see output is fixed. Factors of production. We have seen factors of production. The two production is labor and capital, and they both are fixed. The production technology is fixed. The labor force is fully employed, and we are ignoring money, and we're not also considering prices are sticky in the shorter run. Now we have seen the national savings investment equation. We know S is equal to I, and it's a mix of private savings and public savings. Now this we are going to be using it again and again. We have already used this in some of the problems, and today we are going to be looking through graphs, and so that we drive this concept in a much better manner. This is not a closed economy. This is just to share an example, and we are just looking at how the investment and government purchases have spanned out over the last decade. So if you see in 2008, 2009, the government investments increased. Now this was because of the crisis. Usually during crisis, wars, or even if you take right now during the pandemic, the government purchases would really shoot up. Now this is the equation which will keep on coming. It's known as consumption, investment, and government purchases, which can again be written as, now we saw this is disposable income plus I plus G. Now the output is Y is a function of capital and labor. In this model, we have assumed that the capital and labor is fixed in a society. So ultimately, the output is also fixed. So whenever I'm keeping a bar, it means that particular variable is fixed. The output is fixed. We know tax is fixed. We know government purchases is fixed. Now the only variable which is missing here is investment. Now we can show investment as a function of interest rates. We've seen it before that when the interest rates are higher, when the IR increases, the investment decreases. Investment for goods and services will decrease. Similarly, because when I'm talking about when I'm talking about interest rates, I'm talking about real interest rates. So we have seen that interest rates defines nothing but defines cost of funds. So we know nominal interest rates is equal to real interest rates plus inflation. So when I'm talking about inflation, usually you show it with this sign. So this is Fisher's equation. At higher interest rates, the demand, which is basically for goods and services, lower. So lower is the level of investment. At higher interest rates, the cost of funds is higher. So a lot of projects are not profitable, or a lot of investments are not profitable. Projects, we could say, are not profitable. Since we know this, so let's understand what happens within the society. At higher interest rates, we have a low level of investment. When IR rises, we have level of low level of investment, which means there is a low demand for goods and services. Now, since there is a low demand for goods and services, the demand is lower than the supply. Now, if you look at when the interest rates are IR is lower, the level of investment is high. Which means there is a high level of demand. So the demand for goods and services exceeds the supply. So when you look at when we're looking at IR, ultimately we decide and we understand for at equilibrium, demand is equal to supply, which means interest rates, that is IR, is the prime decider of demand and supply within the system. So this gives you a fair idea of the only thing which is variable here is interest rates, which is what interest rates are deciding the investments within an economy, which is nothing but the demand and supply for which is nothing but demand for goods and services. So if IR is at a higher rate, we saw when IR is high, investment is low. What it means when investment is low, that your demand for goods and services is low. So demand is lower than supply. Similarly, when IR is low, demand because investment is high, demand exceeds supply, and at equilibrium, demand is equal to supply. This is the equation where, and this is nothing but national savings. We have seen this is private saving, and this is public saving. Now from this equation, we are going to substitute whatever the equations which we had before. We have seen that how IR, this equation could be again rewritten as and this is nothing but S. So we look at S equal to IR. So now there are certain things we understand. We see nothing but savings is a function of output, which is fixed. We have also seen tax and government purchases is fixed. So ultimately we are looking at that savings is fixed, whereas IR is used to vary investment. Assumptions which have already worked out. First, We are looking at savings, which is, whenever I'm talking about savings, I'm talking about national savings. So, but I'll just write savings. Now, savings we have seen is not a function of interest rates; it's a function of fiscal policy. And in this fiscal policy, we have kept both we have kept both tax and government purchases as constant. So, and we have seen savings is not a function of interest rates. Second, investment depends on we have seen investment. And when we are talking about interest rates, we are talking about real interest rates. Whenever you are talking about loanable funds, we are taking into account households. Now, there are two ways investors can go to the market. There are two ways investors can raise capital. One, they can go directly to the public and raise capital, which is through bonds. Now, I suggest there are a lot of presentations on bonds. You could look at and you'll have a fair understanding of what these bonds are. Second is private. So they can directly go to banks. This is an indirect way of going and raising capital. Now, loanable funds is nothing. Loanable funds we have seen is constant. We are assuming that the funds which is loanable funds are funds which householders have, and this particular funds are base. This is nothing but investment and saving. The saving which we call is constant. The saving is not a function of interest rate. So that's why savings is not changing. It's a function of government and taxes, and G and tax is fixed by the government. So in this case, since it is fixed, we are taking savings as fixed in this particular case right now. At equilibrium, quantity of loanable when IR is higher, the cost of funds is high, so it's not very profitable to invest in a lot of projects. So investments would go down. The supply for loanable funds is higher than this demand for loanable funds. Markets is not in an equilibrium. What happens when IR goes down? When IR goes down, the investments would go up because investors would go chasing projects. So investments at that point of time are higher than, since investments are higher, basically householders. So what happens in this case? the supply is less than demand. Now at equilibrium, we know supply has to be equal to demand. So ultimately there will be a point where IR, which is known as the equilibrium point, so now let's look at what happens when we change the tools on fiscal policy on savings. So we know savings depends on or is a function of, in this model, government purchases and tax. So we are keeping tax as fixed in the first case and we are changing G. So now we are changing G and tax is fixed. So let this be S1. S1 at the equilibrium, let's say the rates are R1. So when we change government purchases and taxes fixed, we know nothing happens to consumption. Consumption's disposable income we know is Y minus T. Now at Y minus T with T fixed, there is no change in consumption. So no change. The then increase in G the equation we know where C's propensity to consume food is fixed and tax is fixed. I. Now since output is fixed, tax is fixed, this does not change. With the change in government purchase, investment is going to change. Now an increase in government purchases would reduce investment if the output has to remain a constant. Now we know when we increase G, the savings reduce. Now we know this national savings is equal to public saving and private saving. Now when we are increasing the value of G, savings are reduced. The savings, the new saving curve is going to shift to the left. Now as we see, the shift in the savings curve to the left increases R2, which is the interest rates, to R2. So since the interest rates are going to rise, what's going to happen? With the rise in interest rates, the investments goes down. So this is known as crowding out of investments. In this new case, we are going to reduce government purchases. So when we reduce government purchases, we have seen nothing happens to consumption. Now we have seen public saving is given by T minus G. A reduction in government purchases does what? It increases savings, which is known as public savings. Now private saving remains same, so total national savings are going to increase. The savings curve shifts to the right. As the savings curve shifts to the right, the interest rates reduce. So R2 is less than R1. So a reduction in interest rates would increase investments. So let's go to increases in taxes. So before we go to increase in taxes, let's put both the public and private savings equation. We know output is fixed by factors of production. We've seen that. This is nothing but private saving. This is public saving. Now, when you increase the taxes, we are looking at government purchases are fixed, but the tax is increased. So in this case, we are making the assumption that government purchases are fixed. by the factor of marginal propensity to consume into. So an increase in tax would actually decrease consumption. By the factor of marginal propensity to consume. So this is S1 point R1. Now we have seen there is an increase in the savings. So the savings curve would go left. This is the new savings curve. This is R2. So R2 now is greater than R1. So as you increase the taxes, the savings reduces and the investment demand goes up. R2 is greater than R1. So as the interest rates go up, as IR increases, investments go up. So now when we decrease the taxes, the opposite would happen. The increase, as the savings would increase, the interest rates would go down and it will crowd out investment. So that's an opposite scenario which you have seen in the previous case. Now we'll look in the next example how we can make changes in investment demand. We'll now see how to change the investment demand. Now investment demand, one predominant way to change is the technology revolution. We have seen technology innovation play a very dominant role, whether it was either you go back and look at the first industrial revolution or through the tech revolution. If you look between the 90s and the 2000, late 2000, when we had connectivity, today, for example, if you look at online communication, is fostering way of working from home. With the increase in the production, the demand for computer products increased. Other ways through tax incentives. Take the example of the pandemic. If during this time we have a lot of tax incentives to healthcare sector to develop vaccines. Now so this will increase. This is a good example of how investment demand will increase in the pharma sector, or you can say healthcare sector. So let this be IR1. This is the supply of loanable funds. Here you have to be careful. The first was R2. Now the new point, which is the new point of equilibrium, becomes it goes up from R1 to R2. But point be noted, the supply of the loanable funds remains the supply. The supply is constant. The increase in investment demand, let's put it as ID, changes R, that is the interest rates, from R1 to R2. So we see an increase in the interest rates, but the loanable funds remains the same. So now we are taking another case. Until now we had seen savings was not a function of interest rates. So when I'm talking about interest rates, real interest rates, however this is going to change. Now let's assume savings depends on consumption, and if consumption increases, savings decreases, and we are now making savings as dependent on interest rates. So when interest rates are going to reduce, we see the consumption is going to, the saving is also going to reduce. So as the interest rates go up, the so what it is increasing is, so not only the interest rates go up, it also increases the investment demand. So the quantity of the investment demand increases. So this is T1 and this is T2. So R2 is greater than R1, but at the same time T2 is greater than T1. So T2 minus T1 is the incremental amount of investment demand. In this case, we saw that not only the interest rates go up when you are using technology to increase the investment demand, but you're also looking at the how the investment demand as the corpus, as the amount increases, which is nothing but the difference. With this, we come to an end of national income. Going forward, we'll be coming to money and inflation. However, before that, there'll be certain worksheet problems which I'm going to post. Going forward, we'll be coming to money and inflation. However, before that, there'll be certain worksheet problems which I'm going to post. And thank you for listening.